Hey everyone, it's Konrad Bobilak here, CEO of Investors Prime Real Estate and best-selling author of Australian Real Estate Investing Made Simple. Welcome to today's video. Today's video is going to be very mathematically heavy-weighted because it's all about number crunching and how to really look at cash flow analysis on your next investment property purchase. There's going to be a lot of numbers, formulas, but stay with me to the end because it's very important that you listen to this information, especially if you're buying established property and you're comparing the advantages and disadvantages of buying established versus new off-the-plan properties. The biggest difference between the two is definitely depreciation on the building and fixtures and fittings. I've done another video in the past comparing brand new townhouses versus an old house in the same suburb and the advantages and disadvantages of buying a townhouse versus an old house. And the main difference, by the way, and I use the example of Aspendale as an example. The main difference is that with a brand new townhouse, even though you get a lower footprint of land, which is probably 100 square meters versus an average block, which is 600 square meters, you get a brand new dwelling that's 4-bedroom, 4-bathroom, double lock-up garage versus 3-bedroom, 1-bathroom, maybe garage or no garage, depending on the age of the property. And the net difference is you can't claim depreciation on the building anymore or fixtures and fittings for an old house, and your rental yield is going to be around 2.5% or 2%, which means it's going to be draining your pocket every week in terms of cash flow. With brand new townhouses, yes, they don't appreciate as fast as houses. So in an Aspendale area, instead of doing 9.6% for a house, townhouses do 7%, but you can buy more of them because you get to claim depreciation on the building, fixtures and fittings, and rental yields of 4.75%, which means the cash flow neutral or slightly positive, depending on your income. And that's why you need to be able to crunch numbers to compare what you're buying. What I do with my clients, by the way, is I try to get them in a position with the first investment property where it's completely cash flow positive or neutral, which means they're buying a property, they've got the whole experience of working with their team, they settle the property and they're getting $10 in their pocket, $30 a week, net of all expenses. That means that they're not draining the lifestyle. So between the tenant and the tax man, all the expenses are covered, which is great. If you do that from your first experience in property, chances are you're going to go again and again and again. If you buy an old house on a big block, you're going to be killed with land tax, low rental and no depreciation, which means you'll be bleeding 20, 30, 40, maybe up to $300 per week, depending on the suburb and how much you're paying in tax. So if you're an average income earner and you're spending $300 a week on your property, chances are you're not going to buy another one for a long time until your rental catches up and turns that property to cash flow neutral. Some people could wait up to 10 years depending on the area and the suburb and the type of finance they've secured. So today's video is all about comparing numbers on properties when you're out there. What do you look for? What are the minimum variables you need to be aware of in order to make an educated decision as an investor? So welcome to today's video. By the way, this is all just purely educational. I'm not giving you any financial advice. Before you do anything, seek independent financial advice and make sure the person you're getting the information from and the advice has the exact results that you want as an investor. That's the key thing, guys. Also with myself, my background is that I've wasted 4 years at Monash doing a business course. Then I got into financial planning with Australian Uni Funds Management, selling unlisted property trusts. Then got out of there, got into mortgages, residential, commercial, private banking, Medfin for NAB. And now I'm running Investors Prime Real Estate. Literally, this is my 10th year in the company. And it's been a wonderful experience. I've got clients now buying their 7th, 8th, 9th, 10th property using my methodology and my sourcing services. So it's been really an amazing experience. Real estate is my hobby. It's my healthy obsession, as I call it. So I never feel like I'm working. I feel I'm just talking to investors all day long, real estate agents, lawyers, accountants. In fact, most of my friends now are accountants, lawyers, real estate agents, developers. My whole circle is pretty much in that property game, which is interesting. I'm also the best-selling author of Australian Property Finance Made Simple, which you can get at any bookshop, Amazon, Booktopia, or just jump onto bookonfinance.com.au, and also Australian Real Estate Investing Made Simple, which you can get at realestateMadeSimple.com.au or Amazon or Booktopia. That's enough of my shameless plug. Let's get into it. So, Property investor analysis software by Somersoft is my favorite software that I use. I have Excel spreadsheets as well. I have used other software packages in the past. The PIA is the one that I use. It's very user-friendly. And I want to show you today, in terms of investing, what I look for and how do I approach my property investing decisions. And I use the same methodology for my clients. And also it helps me to make very educated decisions about when I'm buying my next property, the property after that, and what my clients are doing as well. So I want to show you some real examples, guys. I don't want to talk hypotheticals. This is a project that we have in Mornington, which is my cheapest project that I've sourced for a long time. It's 130 Wood Street in Mornington. It's $695,000 for 2-bedroom townhouses. Mornington has done really well. It's been a sea change destination for many Melburnians, but you're kind of in Melbourne. I mean, you're 50 k's plus from the city, but you're really about an hour and a half from the city. So if you want to come in on a weekend, to see a sporting event or the footy or whatever, for the tennis, whatever your thing is, you're still in Melbourne technically. The area during COVID has grown by 30% plus. So it's an amazing story. In terms of 12 months growth, 18.1%, 10 years, 8.44%, and in 5 years, 44.7% growth. So during the COVID, the area just went through the roof because obviously it's a beautiful area to be around. But look, long term, you're looking at 8.5%, 8% growth for an average property. The location of this property is really good because Main Street is where all the shops are. And this is obviously the beach. And then this is where the location of the property is right there. So it's really amongst all the shops. It's not far from the medical clinic, but you've got hundreds of cafes, restaurants and retail shops just at your footsteps. It's a really kind of an entry-level property, but very good. I mean, this is something that I would recommend a low-income earner to buy. It'll be set and forget. You're targeting a young professional couple. They're 2-bedroom townhouses. Low maintenance, very small backyards. Literally, this is Main Street over here where all the shops are, and this is just not far from the beach. An amazing area you can see there. It's one of the best places in Melbourne for one of the cleanest beaches you'll get in Melbourne. That's been a draw card for Mornington, and Mornington fundamentally has done really well in the last 10 years. It's definitely an area that I would recommend looking at if you're priced out of the Melbourne property market. The townhouses are pretty basic. They're 100 square metres. On the ground floor, you have a single-car garage. You have a bedroom, which could be a Zoom room, and you've got a toilet downstairs, storage under the stairs. Upstairs, you have an ensuite. You've got a master bedroom, kitchen, dining area, and a balcony. Very simple, targeting the single person, single parent, or a young couple with no children. So very low maintenance, set and forget. It's a great property as a starting point. Great developer, Sentinel Group, great architect. So we have a lot of experience dealing with the builder, developer, and the architect. There's a few left only. I believe by now there's only 3 left. And by the time this video comes out, there could be only 2, which is number 6 and 7. The rest have been sold. You're looking at rental per week of around $500 plus. Council rates $1,800. Body corporate $1,400. By the way, with body corporate, that covers you for building insurance, and it covers your gardening for 12 months and the common area. And there's a driveway that's a common area in this example. So you got to maintain the driveway. You got to make sure there's public liability insurance. It also covers your lighting area and your letterboxes and bin area. So if you haven't got owners corporation, by the way, and if you just say there was no common land in this example, everyone had private access to private frontage and access to the council roads. So there's no common area, which means you don't need to set up an owners corporation. Just for the building insurance, you'll find that on a $700,000 property, it will cost you around $1,200-1,300 per year in building insurance. Plus, you've got to pay gardening on top of that. So just so you know, owners corporations are a good thing. They manage the aesthetics of your property, make sure that the garden looks fantastic, make sure there's no cracks in the driveway, make sure the letterbox and the lights are all there, and it covers you for public liability insurance. So you've got to have all those factors in place. So you have to have an independent valuation. Obviously, when you sell the property, you have a valuation done by the bank, so you know it's $695,000. Then you've got to get an independent rental appraisal, which we have in this instance. So that's the rental estimate per week, 480 to 520. Now, obviously, by the time it settles, then you'll know exactly what the rental will be, which will be mid next year. And by that stage, we'll be looking at 530 to 550 for these properties because rents have gone through the roof. Owners Corporation, $1,400 per annum. And then you have council rates as well, which is $1,800 per annum. Now, on top of that, you got landlord's insurance through Aon, which is $285. This is a depreciation schedule that was prepared by BMT with quality surveyors, which is who I use for my depreciation schedules. They are the best in the industry. And Brad Beer, who's the owner, has contributed a chapter to my book. He's also the preferred quantity surveyor on the block. So they're the ones that do all the depreciation schedules for the block series. So they're pretty much the best in Australia. I mean, I've used the others. They always come in slightly higher. They're just a little bit more detailed in their reports. You can see they're based on his estimation. If you didn't have a depreciation, the property will be negative by $77 per week based on average income. With the depreciation schedule, which means you get to claim depreciation on the building and fixtures and fittings, it's cash flow positive by $11 a week. Now, you might think $11 a week is not a big deal. It's not a big deal in terms of money. You're not going to get rich off $11 a week. But remember, this is only 1 year. The rental keeps going up and gets adjusted at indexed plus whatever the demand is. But also, it's the capital growth that's going to make you wealthy. It's not about the rental yield, guys, in the short term. It's all about the capital growth. I mean, the property goes up by 8%. You've made, on $700,000, you've made $56,000. So how can you save $56,000 after tax? It's impossible. But no one can do it on average income. But you can do it with this property. So in terms of, in terms of stamp duty, it's $36,770. Now let me show you the analysis that I do, which is a little bit more comprehensive. So you have 2 bedroom, two bathroom, 1 car park. You've got a 94 square metre internal, 9 square metre balcony, so 103 square metres. $695 off the plan. That settles mid next year. You've got the stamp duty, $36,770. Weekly rental, $520 a week, which is 3.89%. And then you have cumulative depreciation over the first 5 years, $53,094. Total depreciation, $284,000, which is building and fixtures and fittings. In this example, I had a client, let's call him James. Okay, he's not really, his name is not James, but let's call him James. He's on the 120 a year. He has a clean credit file, house with equity. He's borrowing 90% of $695 plus associated expenses. So he's doing a 90% loan plus 10% from savings and stamp duty. Single guy, works in IT. Very kind of typical transaction. So $695 is the purchase price. Legals are $2,500, which is what your lawyer will charge you to settle the property. Then you got $36,770, which you've got to pay at settlement to the State Revenue Office, and $1,728, which is transfer of title. So your costs, or his costs on settlement, which will be mid next year in June 2024, will be $40,998. Now you have loan costs. Biggest one is LMI, which is 1.5%, which is $9,603. These loan costs are tax deductible over 5 years, which is $14,722. So your contribution in cash is a deposit of 10%, $69,500, plus stamp duty and legals and costs, so $110,498. That's why I say to people, the minimum amount you need in cash to see me or available equity is $112,000, so you can settle a $700,000 property, because you need the deposit and closing costs. You can borrow the LMI, you can capitalise that in the loan. You don't need to pay for it up front. Okay, so, and always pay LMI, by the way, okay, because you want to use the least amount of your own money and more of other people's money to control property. That's the name of the game. In this example, it was an interest-only loan at 4.5%. That's at the time of obviously getting approved. Now, by the time it settles, interest rates could be much higher, but rentals will be higher as well. So remember, as interest rates go up, rentals go up, so they equalise each other. That's the key thing. So he's getting a loan for $640,222. Loan costs can be written over 5 years, which is $14,722, which is that lender's mortgage insurance plus all other costs. Monthly repayment, interest only for investment properties, because only the interest part is tax deductible. You never do P&I for investment properties. $2,401. Repayments per year, $28,810. The rent's $530 a week. Now, I reckon it'll be $550 per week by the time we come to June next year, if things continue on as they go, because there's such a critical rental shortage in Melbourne. I mean, people are sleeping out in tents and car parks. But we'll see what happens. Currently, it'll be $530. So $27,560 is the potential rent. Vacancy rate's 2% per year over 10 years from RP data. So I've averaged that out. So you're getting $27,009 in rental. Now, these are your hard costs associated with the property. You have rental expenses, so there's rental actual costs, and then you have depreciation, which is a theoretical wear and tear of the asset. So you have property management for your 7.7%. Guys, never negotiate a discount on property management. That's one area that you want to actually pay more, or send them a hamper once a year of $50, depending on the property value. If you screw your property manager, they just won't look after your tenants. They won't pick up the phone, they won't address issues, which means you're going to get more turnover of tenants, which means the false economy. Now remember, the difference between 6 and 7% is $1 for every $100 in rent. Okay, so it's not a lot of money we're talking about here. So there's one area in property that I never negotiate, in fact, I overcompensate, is property management. So 7% plus GST, $2,080. Leasing fees, $530, which is to advertise on the realestate.com domain, take all the photos, do the write-up of the property. Then you have the rates, $1,800. Then you have Aon insurance, which is your landlord's insurance. It covers you for malicious damage to the property, accidental damage. So if tenants burn down your kitchen or drop a hot iron on the carpet, it's new for the replacement. And then you have Owners Corporation, which is $1,400, which covers you for building insurance and common areas. So you have $6,105, which is your hard cost per year, which is 22.15% of the actual rent, which is good. That should be between 20 to 25%. So your net rental yield goes down to 3.01%, which is the net means after expenses, which is really cool. So that's a really good scenario. Then you got depreciation on the building, which is $347,500 over 40 years at 2.5%, which is $8,688. And then you've got depreciation on your fixtures and fittings, which is your cabinetry, your carpets, your joinery, your oven, hot water system, dishwasher, all that kind of stuff. So you get $3,604 diminishing value. Okay, so you get more up front when you need it and it diminishes over time. You can do diminishing value or you can do straight line, depending on, and this is something you've got to speak to your accountant, which is the best way, depending on your tax and your income. So in terms of the total expenses, and the loan cost of $14,722 can be written over 5 years. So in the first year, you get to claim the current expenses. $28,809.99 is interest on the loan of the investment property. Expenses all inclusive, which is your council rates, property management expenses, landlord's insurance, $6,104.68. Depreciation on the building, $8,687. Depreciation on fixtures and fittings, $3,604. And then loan costs, which can be written over 5 years, $2,944. So in the first year, your deductions total $50,151, which is huge on someone that's on a $120,000 salary. Now, if this was an older property built in the 80s, you wouldn't be able to claim any building depreciation or fixtures and fittings, which means you would miss out on this amount, which is your building depreciation, that amount. So altogether about $12,000 in depreciation, which is huge. So this person is on $120 per year in IT, single guy. You add your rental income to your job income, which ends up being $147,009. And then you take away your losses, which is $50,151. The losses are from the previous page, which is this amount here, which is the total of all these numbers. So your net new taxable income is $96,858. The current tax that he's paying on the 120, assuming there's no other deductions, is $31,867. The new tax that he's paying on the lower amount is $23,883. So he's saving $7,984 diminishing in the property. So this is what's happening. You have your equity position, So the property is going at 8% per year. The rent is going up. Deductions are going down gradually. This is the cash flow without any deductions from your salary or your rentals, negative 7,906. This is your tax credits from the ATO, 7,984. So the property is cash flow positive by $78 in this example, in the pocket every week, every year. So in this example, psychologically, you're getting $78 per week. In the first year per week, then 1,282, and then it becomes more cash flow positive. This is a great outcome because psychologically, this person can now associate an investment property with cash flow, instant cash flow in the bank account. Now, this tax credit, you can either claim that at the end of the year and just get a check from the ATO, or you can do what's called an income tax withholding variation form and claim it every pay cycle. So this is why we invest in property, to make money based on capital growth. But psychologically, I would encourage you to get the property cash flow positive or neutral just from a psychological exercise. That way you associate a positive notion with buying property. It doesn't matter if you're buying an apartment, a townhouse, house on land, brand new, established, whatever you're buying, it's irrelevant. So the question is, how much does it really cost per week to own investment property in Melbourne? Well, it doesn't really make a difference how much it costs or how much you make. What you want to do, if you can, is match the property based on your income and tax in the way that it's cash flow positive slightly from day one or slightly cash flow negative to the point where it's irrelevant. So if you're on like 200 grand a year and it's costing you 20 bucks per week in the first year and then 10 bucks in the second year, it doesn't make a difference in your life. That's what I'm saying. It's not about the actual amount. It's the psychological impact of buying it, because these are huge decisions, guys. You know, these are life-changing decisions. You're taking on millions of dollars in debt, and you want to have a positive association with debt, because as investors, we've been conditioned that all debt is bad debt. But the difference is, and this is what the rich have worked out years ago, there's a difference between good debt and bad debt. And the sooner you make the distinction, the wealthier you'll become. That's the key element. So here's the reason why you invest in property in the first place. You invest in property not to make this $78 of this cash flow. What we're doing is we're creating equity. So in year 3, you've got $235,000. You take 80% of that, you buy your next property. Then you'll buy another one in year 6 and year 9. So in year 3, he's got 2 properties. Then in year 6, he's got not only this property, but another one. So he's buying 2 properties in year 6, in year 9, another 2. So we've worked out conservatively, based on rental appreciation in specific suburbs, not generally, in the areas we're targeting, this person will be able to buy between 5 and 7 properties over 10 years comfortably and get the tax down to 0. And that's the maximum they can do on the $120,000 income, just recycling equity from the previous properties. Now, in year 10, and the outcome is that the tenant and the taxman pay all your expenses from a psychological perspective. Now, in year 10, you can see there, this is year 10, your rental income after tax is $8,416. But if you pay the property off, right, your rent is, in year 10, $45,000. Okay? So if you're buying 5 properties, what you could do is sell 3 and pay off 2 completely. That means you've got incomes of 2 times $45,000, which is $90,000 with no debt. Or you can buy 7 properties, sell 4, pay off 3, and you end up with income of $135,000, which is more than he's earning right now. So he'll be able to, in year 12, 15, replace his income passively, without even trying too hard, and basically travel the world to do whatever he wants. If you're starting this in your 20s, by mid-30s, you can truly be financially independent. And this is a conservative estimate, just recycling deposits from equity. Think about if you save more money or if you introduce another property into the mix. I mean, you could be financially independent in year 10, year 11, year 12, depending on how fast you grow and how much money you invest. The only person that's responsible for your wealth and security is you. And remember, what you want to do, whether it's established property or brand new, you want to have the taxman and the tenant paying all the expenses for you. You don't want to be contributing towards the property. You're paying a lot of tax as it is. You want to make sure that you're getting all the benefits. This is how we structure our clients' properties. This is another example, which is a 2-bedroom townhouse in Wellington. Sorry, another mistake. So with this example in Mornington, as we mentioned before, based on estimate from BMT, the property was cash flow positive by $11 a week, based on generic income and how much people were earning. Here's another example of Carnegie for $1.2 million. This is sold out, this project. This is a client that purchased this property here, and I'm just going to, this is a typical townhouse that I always source, $1.2 million in the blue chip area, like Murrumbeena, Carnegie, Bentley East, Bentley, 177 square meters. So we're talking double garage, bedroom downstairs with an ensuite. Then you have open plan living on the first floor, kitchen island bench top, another bathroom with a laundry for the guests, balcony, and then upstairs you have 2 bedrooms. You could potentially have the master bedroom here, I mean either or, and plus you have 2 ensuites. So here we have a typical 3-bedroom double look-up garage townhouse, which is like your bread and butter for every suburb. It's the most leasable kind of property out there. 177 square meters. We're talking 1.2 million. In this example, and I'm just going to go through this example very quickly, the rental is obviously much higher. You get higher depreciation. Same scenario for a client. And in this example, we had a couple which did a split. The husband's on 151,000, the wife's on 90. $241,000 was the income, and in this example was cash flow positive by $2,552 in the first year, which is really cool. So that makes it psychologically cash flow positive from day one, which means they'll keep going again and again. And just have a look at what they'll be able to do in year 3, another property purchase. In year 6, 2 property purchases. In year 9, 3 property purchases. They'll be able to buy between 7 to 9 properties in 10 years' time. This is after speaking to a mortgage broker, financial planner, and an accountant. So I'm just kind of fast tracking to the end of the movie here. $50 a week, guys. So it's, once again, in that scenario, we structured the client so the taxman and the tenant are paying 100% of the costs of the property. They're virtually contributing nothing to the property from day one. In fact, they're getting money out of the property, which is fantastic. This is another example. And by the way, they're all sold now. When I was hoping one would be available, but they're actually sold out. They're not available anymore. This is an example of a property in Port Melbourne, which is $1.425 million, that also sold just before I did this video. When I was starting doing the video, it was available, but as of now, it's sold and contracted. But this was a townhouse for $1.425. This was completed about 3 years ago, never been lived in, brand new. Some of them had tenants, some of them had no tenants. This was the one the developer used for staging and selling the other townhouses, so you had staging furniture. Which is funny because they always make the bedrooms look, the furniture really small, so they give you this kind of illusion of space. Very good fixtures and fittings. Great property. Port Melbourne, top suburb in Melbourne. I mean, you don't need to, if you know Melbourne, it's got some of the best beaches. 3 k's from the city, great cafes, restaurants, it's all there. It's a very good layout. You have on the ground floor a study nook with a powder room, storage under the stairs, laundry. Then you have on the level 1, open plan living, island bench top, great kitchen. You've got a bit of a lookout window. Then you have 2 bedrooms on the level 2 with a common ensuite, built-in robes. And then you have the master bedroom on top with a massive ensuite, double vanity, double shower, built-in robes, and a massive balcony. Great property. In terms of square meters, you're talking 183 square meters total. That includes the outdoor area. Now, this Port Melbourne, I mean, it's a success story. 6.57, 12 months, but 5 years, 28%. 10 years average, 8.14. The reason it's 8.14 is because you have a combination of all the properties and new properties. So some of the old Victorian properties that are unrenovated, where you've got 2 bedrooms and 1 bathroom, they haven't done too well. The new ones are doing 11, 12% per annum. The other ones are doing 6, 7%. And the blocks are tiny in Port Melbourne. Remember, the average block is 130 square meters. It used to be a very poor area 100 years ago. It was all shipping yards, and people that were living and working in the shipping industry. So great property. Once again, the cash flow analysis from BMT without a depreciation schedule, negative $183 per week. With a depreciation schedule, $9 cash flow positive a week. And this is based on council rates of $1,800, strata of $800, agents, property management fee of $4,575, insurance $2,200, repair and maintenance $500, water connection $700, interest 4.5, 80% LVR, and so it's a conservative estimate. The ones that we did makes the property cash flow positive from day one for the couple by $2,500. So not per month, sorry, per year. So it's a great outcome, and this is kind of what I do with my clients. I try to match the property based on their specific needs, their tax, their objectives. I've got access to 1,500, sometimes 1,800 properties. Before COVID, I had as many as 3,000 properties. Now I've lost half the volume. A lot of developers are not developing anything at the moment. They've shelved projects because of this escalating cost of construction. So they're trying to come back when inflation stabilizes and fixed costs can be actually attainable, because fixed contracts are hurting a lot of developers. A lot of developers, just so you know, like Porter Davis, were completing properties at a massive loss because they had to honour those fixed contracts, and cost of construction materials have gone through the roof, petrol has gone through the roof, even labour costs have gone through the roof in the construction industry. So remember, there's 4 types of investor categories you're going to be placing yourself right now where we are in the property cycle. You can have the analytical compulsive information gatherer, which is your typical engineering person. They never take action. They keep paying 100 grand a year in tax or less. God knows why. They have Excel spreadsheets and they're just trying to get into the market, but something's holding them back. I would recommend just jumping in with a cash flow positive property in the blue chip area. I mean, it's a no-brainer. You have the get-rich gambler, which want massive returns instantly, which I can't help them with. And I probably would recommend those people do something else like crypto or stock market, because property is a get-rich very slowly over a long period of time kind of a deal, unless you're a developer. But with developing comes a lot of risks. And we've seen recently there's thousands of companies that have gone under, and developers and staff members, and they've taken down businesses with them in the last 2 years. The comfort zone investor will buy a property within 3Ks or 4Ks of where they live, so they can drive by every day and make sure it's still there, it doesn't disappear overnight. No comment. And the active, savvy, educated investor is the ones that I want to deal with. People that are they're emotionally detached from the whole process, they're unemotional, they're buying for the rental market, not for themselves to live in. So if you're interested in learning more, I encourage you to attend the up-and-coming Real Estate Investing Fast Track Weekend that I'm running every 2 months now. It's right here in the office in St Kilda. There's only 55 seats and they do sell out very quickly. So if you want to learn how to pay off your mortgage in record time, how to do unbiased due diligence and research on the property market, how to identify hotspots and future hotspots of tomorrow, and how to avoid areas and specific types of properties like Dockland, South Bank, and house and land packages in underperforming areas, feel free to subscribe and get your tickets. There's a link just down below. Make sure that you register, and it's $47, plus you get a copy of my book as well, which is Australian Real Estate Investing Made Simple. You also get a recording of the whole 2 day as well as a bonus just for reserving your tickets. So it's only available every 2 months, live in the office, and it's a great 2 days. People love networking, meeting other like-minded individuals. Sometimes the difference between investing and not investing is just being around the right people. You might be in a situation where your friends are negative, everyone's doing it tough, but there's a lot of people that are doing it easy at the moment. A lot of my clients, the rentals have gone up by 30-40% in 12 months. They don't really care about the interest rates going up because they've been equalised and surpassed by how much they're making on rentals. So sometimes you just need to surround yourself with people that are a little bit more advanced than you, that are more positive, and they will take you up to their level. Also, if you want to buy the Property Portfolio Accelerator Summit Home Study or online video course, this is something also great as an investment. 30 hours of content. It's $1,000, guys. It's the best $1,000 you're going to spend in property education. It's current. It's based on the Melbourne property market. It's 30 hours plus a manual. It's a recording of a 4-day boot camp from 2022, and the feedback we've had was amazing from people that have already watched the home study. They said it changed their whole perspective on investing in property. The tools that you have and that you're given and the contacts, they're all real, they're live. It's just an amazing experience. So definitely I encourage you to get a copy for yourself and start educating yourself. If you can't make it to my live event, this is the best thing to do, is to get your hands onto this online video course. Finally, for those of you who are interested in tapping into my services, where I source properties and help you build up your property portfolio, I encourage you to book a Zoom meeting with myself for 60 minutes, which is completely free obligation. That's where I take an idea and turn it into a plan and action. And remember, if you fail to plan, you plan to fail. You know, we're at the beginning of the next property cycle. This is the time to get educated, to get your team together, to make sure you don't miss out on this opportunity. Guys, if you invested 10 years ago, you would have doubled your money on properties. The best suburbs in Melbourne have more than doubled in the last decade. If you invested in 2013 in any of the areas that I discussed, you would have more than doubled your money. We're at the beginning of that cycle again. This is the time to get educated. This is the time not to jump in, it's to get educated, to make sure you make the best decision for you and not listen to people with no results. During the consultation, basically, I'll work out where you are financially, work out where you want to be, and I'll show you how to get from A to B with the path of least resistance. Most people end up doing this in their life, which is not the most efficient use of your time. Remember, guys, you can always get more money, but you can't get more time. Time is always running out for us. So it's how you use your time and not how much you earn and how much you save that determines your wealth. So it's an hour consultation. You walk away with a plan. You get the whole team. You get the financial planner, the mortgage broker, the lawyer, right down to property management, leasing, building inspections. You walk away with a step-by-step blueprint of what you can do to move forwards and build up your wealth. To qualify, all you have to have as an individual person, income of $95,000 per year as a single borrower and $112,000 accessible equity or savings. If you're a couple, you need to be on a kind of 120, 140 income and $112,000 in equity on savings. Basically, you need to have closing costs for a $700,000 property because that's the cheapest properties that I source. Most of the properties that I'm sourcing are about 1.2, 1.3, but the cheapest entry ones are $700,000. So if you feel like you want to book in a session with myself, and I'm running out of spots, I am running at nearly at full capacity, and I will be a point in the future where I'm not going to be taking on more clients because I've got clients now buying their 7th, 8th, 9th, 10th property. And I have hired already another person that's going to be working with my future clients. So there are a few spots left if you want to book yourself in. All you got to do is just email me directly, conrad@investorsprime.com.au, and just send me an email that you want to book in for a Zoom session, and I'll be more than happy to book you in. That's it, guys. Thank you very much for spending this time with me. I hope you enjoyed the video. This is Konrad Bobilak. I'll see you on the inside.